Mark, it's really good to see you. Today, we are walking through the three different tax buckets, and we're doing it because strategic planning utilizes a combination of all three accounts, which can reduce your taxes in retirement. So, I want to talk about the first bucket, which is probably what most of us are familiar with. This is the tax deferred bucket.
Yeah, thank you so much for having me again, Erin, and it's great to be here. So when we talk about this tax deferred bucket, most of us, if when we started out early in our career, this was really our only option. And they said, hey, early on, if you defer the taxes, so we did payroll reductions into these plans, 401ks, TSP, whatever it was. And ultimately, all of this money is growing tax deferred. So we've never paid taxes on it, which is great. But then when we get to retirement, now we have to take it out and pay taxes. And ultimately, that's if we go into higher tax rates, because the writing's on the wall, tax rates are going up, that's going to create some problems for us.
Mhm.
But deferring taxes, yes, for many people has been a great solution.
Right. But there is a reason the 401k is known as the retirement tax time bomb. Good point. So, the next bucket that I wanted to talk about were our taxable accounts. What are they?
So taxable accounts can be anything from bank accounts, where we have interest bearing accounts, CDs, brokerage accounts. So the advantage here is you're paying taxes as you go. However, we have to deal with capital gains tax. So we have long-term capital gains. So as long as we hold the asset for more than a year, we pay a lower tax rate, either 15 or 20%, but we do have to pay taxes on interest and dividends as we
Mhm.
go. So sometimes that could be advantageous, sometimes it's not.
Okay.
And by the way, the money is always liquid. We don't have any of these penalties taking it
Right.
out, pre 59 and a half like we do on qualified accounts like 401ks and
Mhm.
IRAs.
Mhm. Yeah, a lot more autonomy. And then the last bucket are our tax-free accounts. I like the sound of free, Mark.
Yeah, I mean, who doesn't like tax free? The challenge is, see, again, we go back to when we all started these plans, we deferred taxes. So the majority of people that come into our office, most of their wealth is tax deferred. And the
Okay.
challenge is really looking at the tax planning opportunities that they have to get more into the tax free bucket. Because if you think about it, if I can pay taxes now while taxes are on sale, and all the growth that incurs on that account is tax free, I have no required minimum distributions. It doesn't hit my federal tax return. Therefore, the other thing is we're seeing people that are paying Medicare surcharges, and which is creating higher premiums, and
Mhm.
their required minimum distributions are going up every year. Tax
Mhm.
free means it never hits the 1099. So ultimately, if we structured things correctly, which for some people there's not that opportunity because you have a pension, but if you think about it, you could get to where you don't even have to file a tax return if the majority of your wealth was coming out tax free.
Okay. Well, I'm glad we're walking through this. I really want to get into some specifics though, because as we talk this through, it's obviously obvious that there are so many retirement accounts to choose from. How do you figure out the right combination then when it comes to tax diversification?
Well, when we talk about tax diversification, again, I would say 90% of the people come in do have a tax problem. And by
Hmm.
that, what I mean is they deferred most of their taxes, or they're continuing to defer. And a lot of people think, well, I'll take Social Security early versus and let my 401k or my IRA continue to grow tax deferred, because we're all used to accumulation. We don't want to take it out. Some mentally we kind of become hoarders of money because we go, no, I don't want to spend it yet. But if you think about it, the longer we defer it, the more tax problems we're going to incur. And if
Hmm.
tax rates go up, it's going to create a big problem. So we
Hmm.
have to get back to the income gap, really understanding how much guaranteed income do we have, what is the income gap we need to meet our lifestyle needs, and then ultimately structuring the right types of tax buckets going forward.
Hmm.
Ideally, Erin, what we want to do is basically move as much as we can from the tax deferred into tax free. Now, that's the tax planning opportunities, and everybody's situation's different. But again, those are the things that we need to open the door on and really take a hard look at, because it's all about mitigating threats And
Mhm.
yeah, when we think about retirement income planning, it's not cash is king, it's cash flow is king.
You bring up so many good points, Mark. Of course, living in a historically low tax rate right now is such a great point. It was really helpful to walk through this. If somebody has questions, again, about figuring out the right combination for them, what's the best way to reach you?
Well, the best way to reach us is you can either go to our website, which is mcgregorwealth.com, or you can actually call our office, talk to one of my team members or myself. That phone number is 303-681-0113.
All right. Mark, thank you.
All right. Well, thank you, Erin, and have a wonderful day.
You too.
All right.